Brad Williams, Frugal Finance. A stacked hedge example in previous sessions. Perhaps you didn't sign up for, what was it? I don't know. I was looking at probably stock hedges or just stocks, and I probably mentioned stacked hedges. Well, here's a simple second example if you didn't catch it the first time around. The construction company decided to lock in the borrowing rate by hedging with the euro-dollar future. Well, we know that. To implement the hedge, the firm sells 300 December euro-dollar futures. The firm hopes to protect itself against any changes in interest rates between September and December. In December, the futures will expire and the firm will offset the December futures and replace 200 of them with March futures. This is a stack hedge because all the future contracts are concentrated or stacked in a single futures expiration. We now consider how the construction firm fares with a single change in interest rates over the next year. Shortly after the firm enters the hedge, we now consider this construction firm, therefore the firm's borrowing costs for the next three quarters are as follows. September 20, borrow $100 million at 9% for 3 months and commit to extend the loan for 3 additional months at a rate of 200 basis points above the 3-month SOFR prevailing rate at that time. Sell 300 euro-dollar future contracts at 92.7, reflecting the 7.3 yield. Then December 20 comes around, pay interest of $2.25 million. SOFR is now at 7.8, so borrow $100 million for 3 months at 9.8%. Offset 300 December euro futures at 92.20, reflecting the 7.8 yield, produces a profit of $375,000 equals 50 basis points times 25 times 300 contracts. March 20, pay interest $2.45 million and borrow $100 million for 3 months at 10.10%. June, pay interest at 2.53 and borrow $100 million for 3 months at 10.4. September 30, pay interest of $2.6 million and principal of $100 million. Total expense, $9.85 million. Futures profit, $375. Net interest expense after hedging, $9.825. December 9.8, 10.10. With the shift in rates, the firm must pay $9.85 million in interest, which is more than the expected $9.45 when the firm took the loan. This difference is due to the across-the-board interest rate rise of 50 basis points. The same interest rate rise generates a futures trading profit of $375,000. Thus, the futures profit exactly offsets the increase in interest rates in the construction firm, and the construction firm has successfully hedged its interest rates using a stacked hedge. We now consider a potential danger in using a stack hedge of this type. In the example, the stack hedge worked perfectly because all interest rates changed by the same 50 basis points. As a result, the stack hedge gave a perfect hedge, and the construction firm had no changes in its anticipated total borrowing cost. The same stack hedge might have performed very poorly if interest rates had changed in a somewhat different fashion. For example, after the loan agreement is signed, the funds received in the same stack hedge is implemented. Assume there is a single change in future yields as follows. December futures yield rises from 7.3 to 7.4%. The March future yield rises from 7.3 to 8.3%, and the June futures yield jumps from 7.9 to 8.6 as shown in figure 6.5. With these changes in rates, the construction firm will have the following borrowing costs and interest expense. $2.25 million, $2.3, etc., $9.825 million, as noted above. For simplicity, we consider only one interest rate change, so the firm secures these rates. Table 614 shows construction firm's transaction and the results of the hedge. The firm hedges its $100 million loan with 300 contracts or $300 million of underlying euro dollars. After taking the loan, the first quarter rate is fixed at 9%. Therefore, the firm's at risk for $100 million for 3 quarters. Because the maturity of the euro dollar that underlie the futures is only 1 quarter, it requires 3 times as much futures value as its spot market exposure. This change in rates give the same increase in borrowing costs from the initially expected level of $9.45 million to $9.825. However, there's one important difference. The December futures yield changed by only 10 basis points. Therefore, the future profit on 300 December euro contracts is only 75,000, equal to 10 basis points times 25 per basis point times 300. Now the net borrowing cost after hedging is 9.75. This is 300,000 more than initially expected. The graph of 6.5 shows the original position for the December. Okay, I didn't include the graph. No big deal. So just go with this one. In our example of a stack hedge, we assume that all future yields rose by 50 basis points. The rates after this equal jump are shown in the graph. We then consider an unequal increase in rates and the effectiveness of the stack hedge. Figure 6.5 shows these unequal rates for which the stack hedge was so ineffective. With the unequal increase in rates, the future yield curve has steepened considerably. The December futures yield increased slightly, but the March future yield increased more, as did the June futures yield. The poor performance of the stack hedge was due to this unequal changes in rates. Be aware. Be cognizant of this. My suggestion is do a little research. Go back 10 years and look at the volatility and the correlation between whatever instruments and whatever futures and whatever spot prices you're looking at, and do some analysis. Brad Williams, Frugal Finance. Thanks for watching.